This is PKF Texas and another chapter of the Entrepreneur's Playbook. I'm Greg Price, Director of Consulting Solutions, and I'm here again with Rafael Carsalade, a tax director at PKF Texas that specializes in international tax matters. Rafael, welcome back to the Playbook.
Thanks for having me again, Greg.
So Rafael, last week we were talking about creating a tax presence in international countries, and we got to talking about what the options might be in dealing with that. And we almost ran out of time, so we had to cut it off right then. But you talked about options when you have treaties and don't have treaties. So can you expand upon what the impact of that means?
Yes, it makes a big difference. The U.S. has a web of tax treaties, and part of those treaties talk about creating taxable presence in the foreign country. If the U.S. does have a treaty with a country with which you're doing business with, the threshold for you or your company to become taxable in that state is a lot higher, so there's a lot more room to maneuver. If the U.S. does not have a tax treaty with that country, then the threshold is much lower and you become taxable in that country a lot sooner, and a lot of times a lot sooner than what you might want or expect.
Wow, that's a very impressive discussion, and I understand now why we have you here helping our clients that are doing business overseas. Thanks for being here.
Thank you.
This has been a Thought Leader production brought to you by PKF Texas, the Entrepreneur's Playbook. Tune in next week for another chapter, and remember, if you're doing business overseas or internationally, give PKF Texas a call.